The final quarter of 2018 got off to a shaky start. The sell-off in the U.S. equity markets in the second week of October saw the Dow tumble by 1,300 points in 2 days. Now, the following session saw a gradual and partial recovery of equities, but volatility continued. The alarm had been sounded, and not surprisingly, there was some panic and the search for a catalyst. I'm joined by Chris Whalen, who is the publisher of the Institutional Risk Analyst at the NASDAQ MarketSite. Chris, great to have you here today.
Thank you, Remy.
Well, here you are at the NASDAQ MarketSite. You just returned from Washington, D.C., and you attended the MBA annual conference. So I think I'd like to start out by talking about housing. Now, fundamentally, nothing has changed as this quarter starts off. Economic data, as well as the political and geopolitical climate, hasn't changed. There hasn't been a seismic shift.
Right.
So tell me about some surprising revelations, if any, from the MBA conference.
Well, the housing finance industry is going through probably its toughest year since the financial crisis. Volumes are down, spreads are very tight. Many lenders aren't making money. You know, if you think about it for a moment, they pay a loan officer a point and a quarter, maybe a point and a half, and the company's not making money. So they're essentially paying capital out to keep their people. The industry has enough capacity to do $2 trillion a year in new loans. We're going to maybe do $1.5 trillion this year, and I think next year will be down. And this is because of the Fed. The Fed pulled tomorrow's sales into today, so tomorrow is now light. And you see the same thing with autos, by the way. Everybody thought we would stabilize again at 16, 17 million autos. No, they're going down. So I think this is part of a structural problem of boom and bust. Prices recovered in the housing sector, but many markets have already peaked. And that's what I keep telling people is the Case-Shiller lags by a year because it's a zip code. It doesn't show you what's happening inside the zip code. And I think that's another issue for the street. They don't see the turn until it's already way too late. So San Diego, San Francisco, Denver, here in New York. New York peaked 2 years ago, high-end properties, and we have a glut.
And Chris, I'm sure you pay attention to the housing figures that are coming out from DC.
Yes.
Now, in the third week of October, there will be housing figures coming out in terms of home builders as well as housing starts. But given where interest rates are and where mortgage rates are going, what do you expect to see as we head into the new year?
I think you're going to see purchase activity fall. You've already seen refinancing obviously fall because interest rates are rising. And there's an awful lot of households out there that have low interest rate loans who either want to stay, say an older couple, or they just can't move. Prices have gone up so much, say in California typically, for example, or Washington, D.C., or any of these hotter metro areas, the move-up home buyer is now constrained by interest rates. In addition to the fact that prices ran up so much, especially the top half of the market. You know, so here in New York, anything above $1 million isn't moving out in the suburbs. Connecticut, you know, maybe a little higher price point, but no volume. And you see the same thing in places like San Diego, Newport Beach. These were all very hot markets that recovered early, 2010, when the rest of the country didn't recover till 2012. So I think, again, we're facing a structural problem where the Fed feels the need to raise rates, but there's not an awful lot of demand to pull short-term rates up right now. And I think they're making a mistake. You could see some non-bank firms fail next year, and you will certainly see a lot of consolidation, no question. I think we could lose 20% of the issuers in the Ginnie Mae market over the next 24 months. These are smaller firms, mostly private, but they're the customers of banks. And so it will have an impact as we go forward. And the home builders, again, you know, when prices get this high, when rates go up, they're going to throttle back because there's a lot of unsold inventory out there. Here in New York, we have years and years of inventory that people can't really afford. They want to live there. You know, downtown, over in Queens, close in, Queens Plaza, that whole area, it's crazy. It looks like Los Angeles. We're building hotels. We have thousands of apartments over there that are vacant, and people just can't afford the rent.
Well, Chris, you made some very interesting observations about the real estate market here in New York City. And while we're still on the topic of housing, I do want to get your take on innovation in housing. A lot of people comment whether we're talking about the origination or loan business or even acquiring co-op properties in here in New York City. There's still a lot of paper that is involved. Why do you think the real estate industry hasn't moved away from utilizing paper in this age?
You're right. As an industry, Other than loan officer compensation, the poor use of technology is probably the single biggest bogeyman for real estate finance. And I think part of it's compliance. They have been just pummeled over the last few years by the regulators. So they tried to get the process to the point where it was legally safe to make a loan. You see Rocket Mortgage with Quicken. They've been trying to automate a lot of it, capture a lot of information, and make sure that they're okay in terms of getting sued by somebody, because they all have memories of large settlements and lawyers and everything else. So you're right, the industry wants to move forward, but I think the real challenge is to get the states, number one, to agree on what we need to have when a house is sold. What information do we need? Then you could move to some more innovative ways of moving this information around and validating it. Not blockchain, by the way. There are existing technologies out there that are perfectly suitable for this, that are used widely. Blockchain is a pig in a poke. It's a solution that doesn't have any use case, frankly.
Well, Chris, now that we've covered that subject, I want to move on to bank earnings. Now, we've gotten results out from the major big banks, and most of the results weren't surprising in terms of trading as well as rate income. So going forward, what do you expect to see in terms of financials?
Well, the biggest change in earnings this quarter was funding costs, which are going up 55–60% year over year. Interest earnings are still going up faster in terms of the dollar amount. But by the first quarter next year, the cost of funding is going to be rising faster in dollar terms than the earnings on the assets. And that's when that interest margin flattens out and starts to go down. This is because, really, for the last 7 years, the two key pillars of earnings have been cost cutting and really cheap funding. 90% of the flow of interest earnings was going to equity, the equity holders of the banks, so the depositors were getting nothing. So last quarter, total funding costs in the industry for the all banks was $30 billion. It's going to be 50 by the end of the year. It's going to be 70 by next summer. And by then, we'll have started to equalize the balance between what the bank retains and what they pay out for bonds and deposits. And that means we're taking a big chunk out of earnings. And it's not clear to me where we're going to replace that, because, the Volcker rule, the other changes in the regulatory area, residential loans was awful this quarter. Nobody talked about that. The banks are de-emphasizing that. So the mix of business and the rising funding costs, to me, are the big issues for next year.
And as we look ahead to 2019, there are a lot of headwinds. Now, we'll have to continue to keep an eye on what happens globally. But in terms of the U.S., a lot of people are comparing equity market performance as well as there's been focus on rotation as well. And it does come as a surprise when you look at the charts how well U.S. equities have been performing in comparison to the rest of the world. So in terms of headwinds, what are you watching?
Well, again, the change in the Fed's policies is the major issue, because so much of debt issuance over the past 5 years we used to buy back stock. Stock repurchases are still driving earnings per share growth, clearly, right? The banks, best case in point. Credit's not a problem yet. I don't think we're going to see credit as an issue immediately for the banks or even out 2 or 3 years. I think where the pain's going to be is in the bond market. That's where a lot of the financing got done, and that's where a lot of mispricing occurred, where inferior players were getting investment grade execution to sell debt. If they were back in the market today, maybe not. So I think the asset class to really watch is bonds, business development companies, non-bank financial companies, because every time you have a flat yield curve, you have a liquidity problem. I'm sorry, the economists are wrong. They keep telling us it's okay. But these are the same people who did Operation Twist in QE3, which has totally messed up the bond market. The term structure of interest rates, all of that is distorted. So how do you and I figure out what's going on? When the 10-year bond, all things being equal, should be at 4.25 today. Not 3.25, but it's because of the Fed and the way they manipulated the yield curve that we don't have any good reference points for risk. So don't worry about credit for a while. Earnings, as I say, are going to be under pressure because of funding costs.
Sure.
And that is what it is. If you really see a flat curve, then you're going to see leverage players liquidating, REITs, other people who just don't make money in a flat curve environment. And I really worry about the real estate sector. I think that is the silent risk that nobody thinks about because they don't cover it. Think about it. You know, it's CNBC. None of your
Sure.
colleagues in the media ever think about the back of the real estate business, lending, that sort of thing. And historically, it was a big bank business. You didn't have to worry about it, right? It was buried inside Wells Fargo. No. Now, half of loans made every year in the U.S. are non-banks, and they own the risk more and more. So they are customers of banks, but the Fed needs to be cognizant that their policies can put small businesses out of business, and that's what they're doing right now.
Well, Chris, now that we've covered housing as well as bank earnings, I want to move on to some fun topics that financial media. Yeah, well, let's talk about some topics such as blockchain technology, ride-sharing economy, and pot. Now, we know our neighbor up to the north, they legalized the recreational use of pot. And there have been critics, especially economists, talking about crypto as well as blockchain. And there have been some eye-watering, lofty valuations for the ride-sharing companies that have come out in mid-October heading into the new year. So what interests you the most?
Well, I just got out of Square. I was in it single digits. I got out at 80. I just didn't care for the volatility. I've got out of all my lenders. The only stock I own right now is New Residential, that owns mortgage servicing rights. A very strange asset. And, you know, to me, blockchain technology, no. It was necessary for crypto, but it doesn't have a business case otherwise. And it's security on the one hand that we don't need, because most of the stuff they talk about today would be private, so we don't have to have the encryption. And then you have ledgering. And we know how to do that. It's called XML. It's the single largest type of software used in the world. Nothing new here, right? Marijuana, I think it had to happen socially. Will it create a new economic boom? No, I think it's going to steal revenue from beer and alcohol sales. And I think the fight over the sales of marijuana between the existing structure and licensing and revenue collection for liquor is going to be very interesting. Look at California, where the smaller growers are getting pushed aside by big investors. They've already been told that they can't sell directly. They have to sell to a distributor. The state of California is going to regulate that industry very heavily. And I think most of the other states see revenue. That's why they're willing to do it. I also think that the cost of law enforcement to prosecute the recreational use of marijuana is absurd. You can't drive stoned. No, fine. It's the same as liquor. So if you enforce that, and use basic common sense, I don't see any reason why we should criminalize it. It's stupid. So.
And Chris, last but not least, before I let you go, since we talked about our neighbor up to the north, I do want to get your take on what we're seeing in terms of trade and tariffs. Now, now that there is this new NAFTA, and a lot of people are talking about the implications of what these tariffs mean for global growth. So what's your take?
Well, look, Trump, I worked on NAFTA years ago. Trump had to do this politically. Was there unfairness in the relationship? Perhaps. Is the new structure better? We'll find out. But these are our neighbors, our brothers and sisters. We are tied inextricably. You know, I always say to people, our southern border is Guatemala, and we should be grateful to the Mexicans for dealing with all of the stuff that goes on the border of Guatemala, because it doesn't come into Texas. You know, we have to have a positive relationship with both of these countries because they're so important to our economy and they're part of our society. We are Norteamericanos, and that's how we should approach this.
Okay, Chris, well, it was so great having you back here at the NASDAQ MarketSite, and thank you so much for your insight today.
Thank you.
Thank you.